Hello, my name is Jesse Colombo, and in today's presentation, I'm going to explain why gold may soon surge to $4,400 an ounce. To begin, let's look at gold's chart and review how it has behaved over the past several months. Gold has been relatively quiet this summer after a strong start to the year, causing many investors to lose interest or assume the rally has already peaked. It turns out, however, that gold's quiet summer trading closely mirrors last November and December, when the metal consolidated in a triangle pattern before surging into a dramatic $900 an ounce rally in early 2025. I believe gold is now on the verge of another explosive move. Now take a look at gold's current chart and observe the triangle pattern that has taken shape over the past few months. It looks remarkably similar to the one that formed in November and December. It's also worth noting that this pattern developed during the summer, which is a time typically marked by lighter news flow and reduced trading volume, as much of the financial world is in vacation mode. With summer now drawing to a close, however, gold has broken out of its triangle pattern, giving a powerful bullish signal and launching what I believe is the start of a renewed bull run into the end of the year. Interestingly, there's an effective way to estimate how far gold is likely to rally now that it has broken out of its triangle pattern. It involves a principle in technical analysis known as the measured move. This technique projects a potential price target based on the size of the prior move and often proves to be remarkably accurate. I created the diagram you are currently seeing to illustrate how measured moves work. It begins with an initial impulse move, such as the $500 advance shown in this example. After that surge, the market or asset pauses to consolidate its gains. This consolidation phase can take various forms, such as a sideways trading range or a triangle pattern. Once the consolidation is complete, the asset breaks out and resumes its rally, typically rising by an amount equal to the initial move, in this case, another $500. It's a straightforward concept, but a powerful one. Now, let's return to the current triangle pattern in gold and examine how high it could rally using the measured move principle. The rally from January to April, which led into the summer triangle pattern, was $900 per ounce. According to this method, a breakout from the triangle will likely produce a similar $900 move, bringing gold to an impressive target of approximately $4,400, representing a very respectable 28% gain. It's also worth noting that both J.P. Morgan and Goldman Sachs expect gold to reach $4,000 by 2026, so the $4,400 target is hardly far-fetched. Another key reason I expect gold to make a major bullish move now that it has broken out of its summer consolidation pattern is that it has also been in a volatility squeeze, which it is now breaking out of. I'll explain what a volatility squeeze is in a moment, but first, it's important to understand that volatility is highly cyclical. While asset prices like precious metals and stocks may not follow clear cycles, the volatility of those prices does, consistently moving through repeating phases of low and high volatility as shown in this diagram. Periods of quiet, low volatility tend to build pressure that leads to sharp spikes in volatility, which then eventually subside, starting the cycle again. One of the most effective ways to measure an asset's volatility is with an indicator called Bollinger Band Width, which is shown beneath the weekly chart of gold going back to 2022. I want to highlight just how extreme gold's recent volatility squeeze is compared to recent history. It is even more pronounced than the one in February 2024, that kicked off the entire bull market, which indicates that the coming surge is likely to be equally extreme. This chart also illustrates the cyclical nature of volatility and shows how the past 18 months of gold's bull market have been driven by a repeating pattern of volatility squeezes followed by volatility breakouts. If you're enjoying this content so far, please consider subscribing to my best-selling Substack newsletter called The Bubble Report, that can be found in the description below. The Bubble Report features detailed analyses of precious metals and comprehensive reports about global economic risks, including dangerous bubbles that are ready to burst at any moment. With over 10,000 subscribers, the Bubble Report has become one of the most popular precious metals newsletters in the world, and a major hit among investors. I invite you to give it a try. You'll find it packed with valuable insights. Now that I've covered the key technical factors likely to drive gold higher in the near future, I will move on to the fundamental factors, beginning with the expansion of the U.S. and global money supply. The money supply refers to the total amount of money in circulation within a country. When the money supply grows, it dilutes the purchasing power of each unit of currency, reducing how many goods and services that money can buy. This is the underlying cause of sustained inflation. As a result, gold and silver tend to rise and serve as effective hedges during inflationary periods. One of the primary drivers of gold's current bull market is the renewed expansion of the U.S. money supply, which began in late 2023, following a rare contraction in 2022 and early 2023. Since then, the U.S. M2 money supply has surged by $1.36 trillion, and with no signs of this growth slowing down, it will continue fueling gold's upward momentum. Paper or fiat money, which includes all major currencies today, such as the US dollar and euro and British pound, is considered unsound because it can be created in unlimited quantities, ultimately leading to inflation. In contrast, gold retains its purchasing power and serves as a reliable hedge against the debasement of fiat currencies. As shown in this slide's chart, when the money supply expands and each unit of currency loses value, gold rises in response, helping to preserve purchasing power. And here's the key takeaway. To be long-term bullish on gold, you simply need to understand that the global money supply is never going to stop expanding. In fact, it's only going to accelerate from here as we approach the end of the current fiat money regime. If you're tempted to think the expanding money supply is only a US issue, think again. This is a truly global problem. Since 1971, virtually all of the world's major currencies have been unbacked by gold, meaning there is no constraint on money supply expansion. To confirm this, just look at the chart on this slide, which shows global M2 money supply. Since 2007, it has soared by an astonishing $73.74 trillion, an increase of nearly 200%. Another major catalyst that's extremely bullish for gold is the runaway explosion of U.S. debt, including, but not limited to, the national debt. Since the year 2000, the U.S. national debt has skyrocketed more than sixfold, from $5.77 trillion to a staggering $37.32 trillion. Even more alarming, it's now growing by $1 trillion every 100 days. This is extremely bullish for gold, because as the debt spirals higher, the likelihood of a sovereign debt crisis increases. In such a crisis, U.S. Treasury bonds will plummet, yields will spike, and the federal government and Federal Reserve will be forced to intervene by printing massive amounts of money to buy collapsing treasuries and prop up both the bond market and the broader economy. But that's exactly when inflation will spiral out of control, far beyond the levels of the 1970s. We're talking 30% inflation per year, then 60%, then 100%, and eventually, full-blown hyperinflation that burns the dollar up. That kind of scenario would send gold and silver soaring, and it's one of the core reasons why these metals tend to follow the national debt higher over time. While I've been showing US-centric charts and data, make no mistake, the rest of the world is facing the same crisis of surging inflation and runaway debt, all a byproduct of fiat money. Global debt has exploded from around $25 trillion in the mid-1990s to $252 trillion in 2025. That's a tenfold increase in just 3 decades. We're fast approaching the breaking point of this global debt bubble, and when it bursts, the fallout will be worldwide. That's a powerful reason why everyone, no matter where they live, should be seeking refuge in gold and silver instead of fragile fiat currencies. In response to the surge in global debt, money supply, and inflation since the pandemic, central banks are increasingly diversifying their reserves into hard assets, particularly gold. Their gold purchases have significantly accelerated, averaging over 1,000 metric tons per year in 2022, 2023, and 2024. This marks a dramatic increase of roughly double the annual average of about 500 metric tons in the preceding decade. Central banks are expected to keep buying gold aggressively, which will continue to push prices higher in the years to come. What will further accelerate gold's bull market in the years ahead is the rotation of capital out of the U.S. stock market, which is currently in a bubble of epic proportion, and into gold. Virtually every major valuation metric confirms that stocks are in the midst of a massive bubble. But the one I want to highlight today is the Buffett indicator. This metric, which compares the total U.S. stock market capitalization to GDP, is a simple but highly reliable gauge of market valuation. It is named after billionaire investor Warren Buffett, who has called it the best single measure of where valuations stand at any given moment. Currently, the Buffett indicator stands at a staggering 214, which is 149% above its long-term average of 86, dating back to 1971. This level is even higher than the peak of the late 1990s dot-com bubble, which ended in a devastating crash. Buffett himself warned that when the ratio approaches 200%, investors are playing with fire. The reason for this extreme valuation is that the stock market has surged far beyond the growth of the actual economy, a classic hallmark of speculative excess. History has shown that valuations eventually revert to the mean, making the market highly vulnerable to a sharp and violent downturn. Given the current extremes, the risk of a major bear market is not a question of if, but when. And when it arrives, it will propel gold into the stratosphere. Based on this and the other factors discussed in this presentation, I believe gold will reach at least $15,000 per ounce in the next decade. While the bursting of the massive U.S. stock market bubble will devastate mainstream investors, those positioned in precious metals will reap enormous gains as trillions of dollars flow out of equities and into gold and silver, driving them to astronomical levels. Capital rotations between stocks and gold have played out in recurring cycles throughout history, marked by major trendline breaks, as shown in the Dow to gold ratio chart on this slide. A break below an uptrend line signals that gold is set to outperform stocks, while a break above a downtrend line indicates the reverse. Historically, every major secular bull market in both gold and equities over the past century has been preceded by such decisive trendline breaks. What's particularly significant is that in the spring of 2024, the Dow to gold ratio broke below its uptrend line. This means that a capital rotation from stocks to gold is already underway, and once the current stock market bubble bursts, this rotation will only accelerate. Capital rotations of this magnitude in secular bull markets in gold typically last 10 to 15 years, which means that the current bull market, now less than 2 years old, is still in its early stages. Further confirmation that gold's secular bull market is just getting started and has many years ahead is its breakout in early 2024 from the cup and handle pattern that began forming in 2011. Breakouts from patterns of this scale do not end in just 2 years, but typically unfold over at least a decade, and the current one is set to match or surpass the magnitude of the 2000s bull market shown on this chart. With this presentation coming to a close, let's review some of the topics we've discussed. After pausing all summer in a triangle consolidation pattern, gold broke out this week, setting the stage for a surge to over $4,000 per ounce. In addition, a volatility squeeze that developed over the summer significantly raises the likelihood of a powerful rally in the months ahead. In the longer term, multiple fundamental forces will drive gold to at least $15,000 per ounce, including the ballooning global debt and money supply, sustained central bank accumulation, and the eventual collapse of the massive U.S. stock market bubble, which will trigger a multi-trillion-dollar flow of capital into gold. If you enjoyed this presentation and want access to more of my content, I encourage you to subscribe to my best-selling Substack newsletter using the link in the description below. Once again, I'm Jesse Colombo, and thanks for watching.